So welcome to those who just joined. It's now time to launch the third EnergyScan webinar session of 2023. I'm Julien Waro. I'm in charge of the EnergyScan platform here at NG Global Energy Management and Sales. And so today we're going to have a traditional outlook on wholesale energy prices, which have come through a volatile period over the past few weeks after months of decline on the back of weak energy demand across Europe. So if the macroeconomic context looks unlikely to provide support in the short term, renewed concern over gas and power supply provided support to energy prices in June and continue to fuel uncertainties for the coming winters. So in this session, we'll try to figure out what the potential risk to come through another period of supply tightness are with our speakers, Olivier Gasnier, Évariste Nouki, and Étienne Covin. So as usual, we'll start with macroeconomics and crude oil trends with a focus, of course, on inflationary pressures and the response of central banks. We'll switch then to natural gas with Évariste, and we'll conclude on European power and carbon markets with Etienne. So let me remind you just before we start that this is an interactive session. So don't hesitate to use the chat module to ask questions to our speakers. We'll do a Q&A session at the end of each presentation. And today we extended the duration of the webinar to 90 minutes to take as much questions as possible. So don't be shy. Finally, we'll also be asked to fill a small survey, a 30-second satisfaction survey at the end of the session. So the slides and a replay of the session will be available by tomorrow at the latest on the EnergyScan platform, and you can already download the slides of the presentation by clicking on the button just above the presentation. So now it's time to start this session with Olivier. So Olivier, the floor is yours now.
Thank you, Julien. Good morning, everyone. I'm going to start by wasting 30 seconds of my precious time to tell you that when you choose the title of the presentation you're going to give for a webinar like this, you have to do it several weeks in advance, trying to find an important theme that is already topical and will remain so when you give the presentation. Sometimes it's a good idea, sometimes the title seems out of step with the present moment. What about this one? I remind you that it is persistent inflationary pressures. Can central banks avoid going too far? Well, I think the title seems really topical today, but the market seems to have already given a clear answer to the question. An answer that is yes, central banks will know not to go too far, which means they have managed to keep inflation under control without undermining growth. And when I say central banks, I'm of course thinking especially of the Fed. Illustration of the optimism of financial market on two examples to illustrate why they are optimistic today. Firstly, nobody would have really predicted that the equity markets would rise so sharply after the US banking crisis broke in March. You can see that this rise was actually largely due to the promise of the development of artificial intelligence, but the first signs of disinflation and also the resilience of the US economy have really convinced the markets that a soft landing for the US economy was possible. That is obviously much less true for Europe, where inflation is still high in the UK, and the Eurozone has been on the verge of recession or even in recession for Germany since this winter. Against this backdrop, it's surprising to see the euro, as you can see on the graph on the right, appreciating strongly against the US dollar, but this reflects clearly the declining attractiveness of the dollar as a safe haven in favor of riskier assets. So now let's turn to disinflation. What stage has been reached in the disinflation process? It has been so far quicker in the US than in Europe because it has essentially been based on the base effect of energy prices, and because on the other hand there are more fixed taxes in European prices. On the other hand, European governments have tried harder to limit the rise in prices by means of subsidies, and so of course, 1 year after, the fall is less marked on energy prices. What can be seen in the middle chart is that the mechanical fall in the rate of inflation due to energy is over in the US and almost complete in the Eurozone. For this inflation to continue now, core inflation must take over. So we are just beginning to see this in the US, where service prices have begun to slow down a bit, but not yet in Europe. And this lag very probably reflects the earlier and more marked monetary tightening in the US. So let's have a look at a bit more precisely at the core inflation. The fall in core inflation is difficult in general to dissociate from the deterioration in the labor market and from a slowdown in wages, which is which are the main determinants of service prices. As can be seen in the graph on the left, wage increases are still far too strong to allow inflation to slow towards 2% in the long term, with the UK looking particularly worrying as a result of the labor shortage following the Brexit. In the US, we are also seeing a reacceleration in the property sector, a very slight reacceleration, but that is due to the fact that the borrowing rates have peaked very early on, last autumn actually. And so activity in the construction sector has fallen very little, and prices have been rising again in recent months. Also, sorry, in the US, the savings accumulated during the COVID period. I think I showed this graph already last time. So the accumulation of savings, thanks to the successive stimulus plans implemented by the Biden and the Trump administrations, still constitute an important buffer that is helping to support household spending. So all in all, can the Fed, which is constantly asserting that it does not want to repeat the mistake made in the early 80s by the Volcker Fed, which stopped raising rates too quickly only to have to resume and push it further than would initially have been necessary? So can the Fed safely stop raising rates today? I think this is really the key question. Um, if we want to have another view to try to answer this question, and it's one way of understanding why the economy seems to be resisting the Fed's very aggressive monetary tightening, and of seeing whether the market scenario is coherent, consistent, it is to look at the level of interest rates in real terms. That is to say, the nominal interest rates deflated by inflation, or expected inflation if we want to look forward. The first chart shows market expectations for Fed, ECB, and the Bank of England policy. So it's currently one more hike for the Fed next week and then nothing. One for the ECB also next week and maybe two. And four for the Bank of England. Note that the forecast for the Bank of England have been revised downwards following the release of lower than expected inflation figures in June, but clearly the expectations are much above for the other central banks. The second chart shows the expected trend in real interest rates based on market expectations on the Fed's core inflation forecast, and also based on our own forecast for core inflation. That makes little difference, just as it would make little difference to take total inflation. You can believe me, and you can check that in our monthly report, because I have put also the chart on total inflation. The conclusion is that real interest rates are still very low, close to zero, and that they should go much lower than they have during each Fed monetary tightening cycle in the last 40 years. So that brings to this conclusion: either inflation forecasts are too high or interest rates forecasts are too low. And I would be tempted to conclude either we have a recession that will really sharply pull inflation lower, that looks unlikely in the very short term, given the figures we have in general from the US economy, or this recession will come later in 24 because the Fed will have continued to raise rates higher, maybe towards 6.5% or more, even more. This conclusion is sorry, I managed to have the following slide. This conclusion is, I was saying, is reinforced by the fact that if you do the same exercise for the ECB or the Bank of England, we find the same historical standards. I mean that we are even higher for the ECB, but inflation, as you can see, that starts only with the creation of the ECB, so 20 years ago, more or less. Inflation has never been so high during this period. It seems very logical that real rates should rise a bit above the previous levels. And for the Bank of England, that you can see that you are more or less in line with the previous levels until the great financial crisis. So that seems really consistent. I mean, the current expectations, which was what we have seen in the past, and so that shows that there is something wrong in the Fed scenario, in my view. Now let's turn to activity very very quickly, because we can see that the latest surveys are clearly not good, and you can see the evolution of the purchasing manager indices here. And it's particularly true in the European industry, where Germany is dragging down the zone as a whole. And this confirms the weakness of Chinese domestic demand, because of course Germany is a big exporter. You have also a very negative trend for Japan, for example, Japan exports. For China, we have seen that the growth figures were very disappointing for Q2. They were well below expectations. The recovery following the exit from COVID measures is really disappointing. But as we have seen, this weakness of the manufacturing sector, this is not really what central banks would particularly like to see. They want to see a slowdown in activity in the services sector, where there is the dynamics of core inflation, and that would help to bolster this inflation. And for the moment, as you can see on the chart on the right, the slowdown in services remains really moderate. So I think with our growth forecast, this is time to answer our initial question. And we believe that, as usual, central banks will find it very difficult to curb inflation without triggering a recession. The most interesting case is, of course, the US, where we believe that the Fed rates could continue to rise. Or worse, would probably have to rise higher if monetary tightening were to stop now, just as it happened in the early 80s. So we are still assuming a recession for 24. That would be without comparison with what happened during the great financial crisis, but that would be really a moderate recession. But China would be this time unable to revive its activity, and that would not offer a way out of the crisis via external demand, as it was the case at the end of the great financial crisis. Of course, you have to keep in mind also that the conflict in Ukraine brings with it major risks, notably that of a rise again in energy or food prices. We have seen the recent decision of Russia to stop its deal for exports of cereals from Ukraine in particular. Now let's turn to the oil market. I remind you that you can ask questions on the macroeconomic section, and that I can answer them later after the few slides on oil. So if we look at the evolution of oil prices compared with the last webinar we had 3 months ago, in appearance little has changed. The price of Brent crude is still around $80 per barrel, except that the fluctuation rate has really shifted downwards on the prices, more often than not being below $80 per barrel due to fears about demand, and particularly as a result of the disappointing recovery in China. If prices have returned above $80 per barrel, it's really thanks to the successive reduction in oil supply decided by Saudi Arabia, or announced so far by Saudi Arabia, now supported in its effort by Russia. That was more surprising, probably. Let's look at this in more detail. So, in July, Saudi Arabia will unilaterally cut its output by 1 million barrels per day. And the country has announced that it will not increase it in August, because at the beginning the measure was supposed to only to be taken for the month of July. But I think it's likely to do the same in September, because they are trapped in a way. I mean, they cannot stop now that they have announced such a measure. For all the OPEC countries subject to production quotas, this means that the potential drop is around 700k barrel per day, but it's unlikely. So you can see that on the graph on the left. It's unlikely that the countries that were unable to produce up to their quotas before will suddenly do so. So you can probably count on fall very close to the 1 million barrel per day announced by Saudi Arabia. And importantly, Russia has also announced that it will cut production by 500k barrel per day in August, which will mean a potential reduction during this month of 1.5 million barrel per day compared with June. Up until June, Russia's earlier statements that it would cut production seem to have really very little effect on exports, even seem to be rising steadily, but the trend has clearly reversed in recent weeks, as shown on the graph on the right. It should be noted that one of the beneficiaries of the sanctions against Russia is Iran, whose exports have probably risen by almost 400k barrel per day since last year, even though the country is still subject to international sanctions. So the conclusion is that there are clear restrictions on the supply side in the short term. Now on the demand side, despite growing concerns, we can see that it's not weakening. Particularly in China, despite the weakness of the post-COVID recovery. There are two main reasons for this. Firstly, the war in Ukraine has given the two Asian giants, China and India, the opportunity to buy cheap supplies from Russia, even though Russian prices have recently climbed back towards the price cap that was set at the end of last year at $60 per barrel. And secondly, export of petroleum products by refiners, Chinese refiners, are up sharply on last year. They are up by a factor of around 3 due to the increase in export quotas from, if you compare to 22. And of course, this is supporting demand for crude oil. And of course, also there is the US recession, which is not coming. That was anticipated, but it has not yet materialized. So it's striking to note also that demand forecasts have tended to be revised upward since the start of the year. If you look at the forecast from the International Energy Agency, the OPEC, or the US Department of Energy. Now, let's look at our supply and demand balance on the forecast. So it's clear that in the short term, the OPEC plus production cuts have really changed the situation for the second half of 2023, as the market is expected to be fairly clearly short of supply, which explains the rise in prices. You can see on this on the line the line on stocks, which is clearly negative, minus 0.9, minus 0.7 million barrel for the third and fourth quarter. So prices in the short term, they could probably go a little bit higher. But the agreement within OPEC is far from perfect, and production is expected to rise sharply in early 24. For example, at the meeting of early June, the United Arab Emirates have already obtained an increase in their quotas. It's also to be feared that at the slightest signs of downturn in demand, the producing countries will no longer have any real means of reacting, since Saudi Arabia and Russia will not continue to reduce their production. Currently, Saudi Arabia is producing probably less than 9 million barrels per day, while it can produce more than 10.5 million barrels per day. This is a huge potential loss, of course. The risk to prices, therefore, appears to be, in my view, clearly on the downside before the end of this year, after which we will have to wait for a rebalancing of the market and prospect of a recovery in demand to stabilize prices, and then to see them rise again. So we could have some tensions in the short term, as shown on the graphs on the right, and then a decline towards probably $70 per barrel. So I'm done, Julien. Thank you for your attention. Do we have questions?
Thank you, Olivier. Yes, one question to launch the Q&A session regarding macroeconomic topics. So what indicators suggest that the US economy will not avoid a recession?
Actually, there are a number of indicators that have been really reliable in the past. First, of course, the inversion of the yield curve, the plunge in the conference board leading index, and it will be released today for the month of June, and the ISM manufacturing index when it falls below 45. This is not yet the case, but it's very close. I think what we have to keep in mind is that the effect of monetary policy takes time. Each time the central banks say that they are going to observe the effect of their policy, but they do not want at the same time a sustained rise in the level of inflation that would alter the expectations of households or businesses, and that would lead to a change in their behavior that would create a kind of vicious circle fueling inflation. So usually they have no choice, as long as core inflation remains high in particular, to keep raising rates. And when the signs of a slowdown appear, it's generally already too late. And it should be noted that, for example, the reduction in the yield curve that we have seen a bit does not mean that we have escaped recession. It's just a normal process that precedes the onset of recession, because the markets are already anticipating the necessary easing in monetary policy, which pulls, of course, short-term rates a bit lower, and they after that they anticipate the recovery, and that push long-term rates higher.
So looking at China, you talked about the disappointing economic performance of China so far this year. So can China achieve a 5% growth this year and in 2024?
Well, it looks really difficult for 23, and probably even more difficult for 24. After the disappointing figures for Q2 in 23, it would really require a sharp acceleration in the second half of this year. But of course, since this is the official target, 5% growth for this year, we can assume that measures to support growth will be put in place very quickly. Well, I'm a bit cautious because so far it has not been the case at all. For next year, I don't think growth can exceed 5% either because the property market is still adjusting and credit distribution will continue to be constrained by the situation because you cannot do both at the same time. I mean, a decline on debt on the one end and also acceleration in credit distribution on the other end. And you can also think that given the forecast I have for the other parts of the world, that China won't be able to. You can think that China won't be able to rely on external demand.
One question on crude oil prices. So the forecast is relatively stable to slightly bearish for the coming months. But are there any risk of a sharp rise or sharp fall in oil prices in the coming weeks or months?
Well, as I told you, I don't see much of an increase. Probably, yeah, maybe there is a short-term potential, but the market is already anticipating a shortage of supply in the second half of this year on above $85 per barrel. Probably Saudi Arabia would seek to increase its output again on its revenues. I didn't mention the fact that Saudi Arabia needs to balance its own budget, needs prices above $80 per barrel. And this is why they have really tried to reduce output to boost prices. If prices go higher, Saudi Arabia will probably try to increase its revenue and increase its production, and that would bring the balance that would bring the market into balance and push prices down. The question seems to me to be how far prices can fall. Actually, if demand turns around, the market will know that OPEC countries have limited room for maneuver now because they have already taken strong decisions. On the other hand, they will know that at $70 per barrel, the US administration is buying or should buy to replenish its strategic reserves that have fallen dramatically. So, if OPEC discipline, in addition, were to break down, a new price war triggered by Saudi Arabia couldn't be ruled out. And in that case, prices could really fall sharply. This is, in my view, the main risk.
Okay, thank you, Olivier, for your answers. It's now time to move on to the gas section with Évariste.
Hello.
Évariste, the floor is yours.
Hello. Thank you, Julien. Good morning, everybody. So let's start with the gas outlook with the European gas balance, the updated balance, now that we have the full values for the first half of the year. So what we do here is just to make the total volumes so far this year and then compare them to the same period of last year. This is done on the last column, the cumulative change. So first message, the unsurprising message, the strong drop in Russian flows. But if you want to be optimistic, you can say that we are still receiving Russian flows, the flows that are transiting via Ukraine. But of course, the drop is massive. The other bad news for the balance is the drop in Norwegian supply, both because of planned and unplanned outages. The other additional bad news is on the domestic production. We are also lower, but you have to keep in mind that last year producers were asked to maximize their production. So the level of last year was high. So to me, it's not so surprising to see domestic production dropping a little bit, particularly as you know, in some countries like the Netherlands, we are still heading towards a strong drop, in particular from the Groningen field. So these are the bad news for the balance, but there are still very positive news, particularly on the demand side. Strong drop in industrial demand and also local distribution zone demand, which is just maintaining of the trend we had in 2022. So we are talking about a drop of 14% since the start of the year for industry, and minus 9% for local distribution zone, which is mainly residential tertiary. And even we are seeing a drop in gas demand for power generation, minus 17% since the start of the year. This was not the case last year. As a reminder, just look at the table. Last year, gas demand for power generation was up just because gas-fired power plants were asked to produce to compensate for the drop in nuclear generation and hydro. This year, it's not the case. You are seeing a strong drop. And on the supply side, we continue to have strong LNG supply. Since the start of the year, we had an increase of around 10%. But you have to be careful on that one, because since June, we are now seeing a drop in the LNG supply to Europe, partly because of seasonality. This is a period of weak demand, so you have an adjustment of supply as well, but also partly because of the drop in European prices below Asian prices, which is triggering slowdown in LNG delivered to Europe. So everything seems fine. And but there are still some risk factors. We already mentioned the LNG supply. We talk about Norwegian supply, the outages, and also you can have a rebound in gas demand for power generation. But overall, the balance seems comfortable. So if you look at the values of total supply drop, of course they are above the drop of total demand. But be careful, this is just because we make the difference by taking some gas from net storage injection. If you look at the table carefully, last year in the second quarter, net storage injection was very strong, 32 BCM, just because we needed at that period to inject to fill our storages, which were rather low. This year, it's not the case. We start with a high level of storage, meaning that 21.6 BCM of injection were needed to make the storage comfortable. So this explains the difference you are seeing in the table between total supply and total local demand. So talking about storage, you have here the overall picture. As I said, if you look at the slope of injection this year, it is slower compared to last year, the blue line. This just explains what I was saying before. This year, we needed to inject less because we start with a high level of storage at the end of 2022. But overall, yes, we are not at the high, we are not at the top of the range, but we are still at relatively high levels, and we are still on track to reach easily, yes, if you want, the European Commission filling target, which is 90% fullness on the beginning of November. In terms of price dynamics, you must admit that you were surprised by the sharp rise in prices at the start of June. As a reminder, this rise was explained by the drop in LNG supply, higher coal prices as well, and also the extension of the maintenance at the Norwegian Nyhamna gas processing plant, and also lower renewable generation lent some support. So strong rise at the beginning of June, but prices drop also strongly from early July. So they dropped because we believe that the market at the end realized that despite all the setbacks we mentioned above, EU gas stocks were feeling well, and additional downward pressure came from the restart as planned of the Norwegian Nyhamna plant on mid-July. So now we can say we are back to more normal level, more normal compared to fundamentals. In the graph on the left, on months ahead prices, you see that we are trading now close to what we estimate to be a technical low, the 20-day low. This level is very close as well to the coal switching minimum levels, meaning that it has also a fundamental backing. So you can have a technical rebound from that level, although we could maintain a rather stable or slightly bearish trend. As for calendar 24 prices on the graph on the right, they are much more resilient. We'll see on the next slide that they are trading close to the top of the coal switching maximum level. So the market continue to maintain a high risk premium on this contract. Why? Because you still have some uncertainties on what, let us say, even worries about gas demand for power generation. You cannot also exclude a rebound in Asian demand, although if you take into account what Olivier was just saying about China, the economic growth is disappointing. So maybe for 2024, we should not have strong rebound in Chinese economy, thus maintaining energy demand there and LNG demand lower. So yes, the risk premium may seem overvalued, but we believe that gradually, as we move closer to the delivery period, we should see a drop in this calendar 24 price. This is what we show in the next slide. You are now familiar with these slides. Also, we just take TTF prices and compare them to their benchmark. You have the coal benchmark and also the oil one. So if you start with the graph on the left, the TTF month ahead, as I said before, prices are now trading close to the coal switching minimum level. An additional drop will be difficult to achieve because of the support of the coal price, of course, but also because of the technical support I mentioned before. But gradually, as you move closer to the end of the year and also closer to the time stocks will be full, prices could continue to drop. So overall, our scenario hasn't changed. We continue to believe that those prices will trade between the 1 year low and the 1 year average. The 1 year low at the end of December will be around 14. The 1 year average will be around 42. The 14 low is very close to the US gas, LNG gas delivered to Europe. So of course, we cannot imagine, at least on a month-ahead basis, prices dropping below US LNG delivered to Europe, because if it is the case, you have low LNG. So this will be the minimum, and this minimum is very close to the 1 year low. On the graph on the right, you have the calendar contract 24, relatively high prices, close to the top of the coal switching maximum level. Again, if fundamentals continue to be comfortable related to stock levels close to maximum, we expect this calendar contract to lose its premium, and at the end of the year, the 1 year low will be around 29, and the 1 year high will be around I guess around 50. So the range would be high, but we expect it to gradually weaken by the end of the year with a drop in the risk premium on this contract. Now, if you look at the picture with a macro view, we should keep in mind that gas prices cannot move separately from prices of other energy sources. According to the statistical review of world energy published recently, last year, world primary energy demand increased by, let's say, only 1.1%. confirming the figure we had so far, primary energy demand was down in the European Union. We are talking about minus 5%, which is strong, while it increased in the US and also in China, much more moderately in China, 0.9%. 0.9% for China is relatively low. This is also to link to what Olivier said about the economic growth in China. In terms of energy sources, demand evolves as follow. You have a strong drop for oil, minor drop for coal, again linked to China because China is the main coal consumer. And for gas, we had a minus 3.1%. And for renewable, very good news, plus 13%. Here too, it's no surprise, the sharp rise in gas prices have triggered a drop in gas consumption. What we are just saying is that demand destruction has played for sure. If you think about the drop in primary energy demand in the European Union, and at the same time, you also have some energy substitutions toward the less expensive energy sources, which toward, in particular, oil. Oil seems to have played quite well its role of energy of last resource. So this makes us think that gas prices should continue to have some downward pressure coming from other energy sources. And in this picture, you have more and more to add renewables. In the graph, you see that thermal fuels continue to dominate primary energy consumption. Oil is still number one, followed by coal and gas. But gradually, renewables are also increasing their share in total energy consumption. And if you just focus on power generation and not on total energy demand, just focusing on the power generation sector, the share of renewable, of course, is even more important. And renewable, as we'll see it later, will more and more have a word to say in the pricing of other energy sources, and particularly natural gas. So does it mean that the gas market is comfortable and we don't have to worry about any slowdown in the increase of LNG supply? You have to be careful. Yes, of course, weak economic growth prospects should continue to limit the growth of world primary energy demand. We believe that will be below 2% and probably closer to the 1% we had last year. With the continued growth in renewables and the expected rise in coal production, particularly in China and India. Last year, as a reminder, if you take China, India, and Indonesia, all those top three producers, they increased their coal production by more than 10%. And they should continue to do so if they believe that going to the gas market to buy LNG will be much more expensive for them. So they have this alternative to continue to increase coal production so as to limit any impact of the tightness in the gas market. So having said that, strong growth in renewable, strong growth in coal production, this means that you'll have less room left for an increase in the gas market share. So if you look at now the supply of LNG, the additional supply we expect in the coming years, you can believe that, yes, the 31 BCM per year liquefaction capacity additions for the next 3 years may seem weak compared to European needs, of course. Because you have to replace Russian gas and to be prepared to an additional drop in domestic production. So although this value may seem weak, if the share of gas doesn't increase, it could be enough. It could be enough, provided that the assumptions we made above, of course, are correct. So I talk about renewables. that are now more and more challenging the other energy sources, the three main one, coal, oil, and gas. And if you look at the current forward prices, you see that in the period 2007, 2028, the market seems to believe that given the expected strong rise in LNG supply, the prices should be bearish. So clearly the market is sending the signal that we should trade below oil prices. Yes, the view could be correct. But by then, in the meantime, we believe that the coal switching level could continue to lend some support. But even this view is now challenged by renewables. What we add in the graph is a kind of renewable switching level. What does it mean? As we do it for coal, we also compute for renewables the gas price that make gas cost for power plants equal to renewable cost for renewable power plants. Here we take wind and solar, and the assumed costs are the levelized cost of electricity, the LCOE. And of course, you also have to make an assumption on the capacity factor of the renewables, their production level compared to their installed capacity. Here we took a value of around 48%. And we also assume that when renewable generation is not enough, the renewable power plant has to compensate by using a gas-fired generation unit, or even buying the gas on the marketplace. So by doing that, we can compute this renewable switching level. Of course, you can have an assumption as well on the LCOE. That's why we had here a range. But what the graph shows is that in 2027-28, when gas prices are relatively weak, the renewable price can be a factor that could explain why we are at such levels. So we believe that gradually we have to include in our analysis the price renewables is at which renewables is willing to sell, and then you have more and more in the energy complex to take care about oil prices, coal prices, gas prices, of course, but also renewable prices as well. So that's it for me, Julien. I don't know if you have some questions for me.
Yes, thank you, Evariste, for your presentation. Yeah, we have a question in the chat room. So let me publish it for everybody. So yeah, you mentioned at the beginning of your presentation the drop in gas demand in Europe following the surge in wholesale prices. So question for the coming winter period: what is your view on potential rebound in LDZ, so residential heating demand for the winter ahead due to price caps and falling retail prices? Example in the UK. If we add a cold winter as well, does that raise concern for the post-winter storage level and then 2024?
Yes, this is clearly a risk factor. So since the start of the year, as I show in the table, LDZ demand was also down. We believe that this drop, of course, is partly due to the weather, meaning that if you have a colder weather, there could be an upward trend on LDC demand. But the drop is also due to price response. People have discovered that they can reduce their energy consumption while keeping the benefit of the energy they were receiving, in fact. So between a heating temperature at 21 and 20, the difference could be minor for you in terms of comfort, while on the price, the difference can be very strong. I think that people now have taken this into account. So yes, if the weather is colder, you could have an uptrend in electricity demand, but I'm not sure that this uptrend will be stronger as before, because we believe that now the price impact will have lasting impact. So I'm not really to say afraid about the surge in electricity demand, even if you have a cold winter. I believe that price response could still limit the impact.
All right. Thank you. Just coming back to the presentation. So we see that there is a significant backwardation in the TTF prices for the coming years. So is it a good strategy to fix on the distant maturities, in particular Cal 27 and Cal 28, which are quite low at the moment?
Yes, I think so. I think that the graph clearly shows that at those prices are for 27, 28, you are trading below Brent prices, and you are also trading significantly below coal prices, the coal switching average level, and you are trading at the bottom of the renewable switching level. What does it mean? It just means that the upside potential from those levels is rather high, and you have some risk factors on those factors. If you think about coal, I have to think about China. 27, you are far from today. We think that at this period probably will have a rebound in Chinese economy, meaning that they could have also an upward pressure on coal prices. Even if you take the CO2 content apart, you can also have, if coal prices are high, an upward pressure on gas prices. And the same for Brent. If you are below Brent prices, it just means that all the effort that were made in industry, but also in LZ. Now we talk about LZ as well. You have some substitutions. If you want to heat, you have some substitution between gas oil and natural gas. If gas prices are so low in 2027, you could have some reverse switching from oil to natural gas, also pulling demand up and also prices up. And renewables is also a risk factor. As a reminder, here we take a capacity average at around 40, at an average of 48. If you have less than that, it also means that, yes, you have an upward pressure on gas prices. For all those reasons, I believe that at least taking part of fixing part of the volumes for 2027, 2028 could be a relevant strategy.
Okay, we have another question from the audience. So how can you explain the increase of I think TTF Cal 24 pricing since this week? Are there some specific reasons?
I don't see specific reasons apart the fact that you have this rebound in the Monset. As I say, Monset prices were trading close to the coal switching minimum levels, and then they found a support. This means for the market that the coal level is still very relevant. And on top of that, you have a rebound in coal prices, in fact. So rebound in coal prices, as I mentioned, this is having an impact on European prices, of course, on the coal switching level. But this is also having an impact on the Chinese market and the Asian market as a whole, because prices are rebounding because coal prices in China are rebounding. they can rebound because of demand. They can rebound as well because of production cuts. But at the end, it means that for Chinese buyers, the competition, the substitution between gas and coal will favor as well a rebound in gas prices if coal prices are rebounding. I think that this is what is spreading as well to TTF Cal 24 prices.
Okay, we still have some time to take one last questions. So one question on Chinese gas supply. So China is increasing imports by pipeline. Do we anticipate a decrease of energy demand from China in the coming years?
Not easy to answer that one because it will depend on let's say on Chinese economy. What will happen is you start with an assumption on Chinese economy, then you move to the underlying energy demand. And this underlying energy demand, you could fulfill it with coal first because this is their, their major energy source. If coal production continue to increase as expected, it means that this will lower the need for the other energy sources. So lower the need for gas demand. And then you have to add in the picture the fact that there are also major gas producers. We tend to forget it, but China is also a major gas producer. So the more they will produce gas, the less they will need to import. And the more they will import via pipeline, and you are right to mention it, they are now importing massive volume from other suppliers, and now more and more from Russia via the power of Siberia, and they want to increase those flows. This means that yes, you could end with China LNG demand continuing to weaken. Of course, if the economy rebound is stronger, you can still have an increase in LNG demand. So I'll say that all will depend on the outlook you have on the economic situation in China.
Okay, thank you, Evariste, for your answers. So now it's time to move on to the power part with Etienne. Hello, Etienne.
Hello, Julien. Good morning, everyone. So, as Julien said, today I'm excited to present you the latest developments in the electricity and carbon markets, along, of course, with our insights on the future trends. So, without wasting any time, let's start right away with the power markets fundamental, and more specifically, the electricity consumption in Europe. Well, it has been one of the main drivers behind the retracement of prices this year, and there actually was little change over the past weeks. So as you can see on the left chart, the power consumption corrected from temperature's effect remains below normal, with a demand recorded by TSOs 4 to 8% below average in northwestern Europe in June, and actually no reliable sign of recovery. This is again the result of still historically high energy prices, even though there was a retracement, a challenging macroeconomic environment, to say the least, with high inflation, and the long-lasting effect of the energy-saving measures implemented last winter. So you may have heard about the stronger demand in June, and it's actually true and has been a support to prices over the past weeks. But be really careful with this kind of info, as it's only the effect of a lingering heat wave which strengthens the power for cooling demand. Overall, the electricity consumption remains curbed, and as shown by the right chart, which my colleague Olivier already presented you, the outlook does not look bright. Indeed, you can see that the manufacturing PMIs, which is the most used indicator of the industrial sector's health, have been worsening over the past weeks. And this suggests that we shouldn't expect a recovery to pre-crisis level of industrial production in the coming months, and therefore that the power demand should remain below normal this summer. And this actually was confirmed by RTE in its summer outlook that was just published a few days ago. Okay, moving to the supply side of the market. So one thing that stands out immediately when looking at the European renewable power production is the incredibly strong solar generation the market has observed in 2023, which you can actually see on the upper left chart. So basically, this is the result of a massive installation of additional capacity last year, and as you may have guessed, it has had a noticeable impact on prices, which of course I will present to you afterwards. But to give you an order of magnitude, the Netherlands have increased their solar capacity by more than 25% last year. Now, regarding the other renewable production, you can see that they are also in the upper end of the historical range. The wind generation seems very high in July, but it's actually due to a temporary wind surge earlier in this month, and unfortunately, forecasts are showing a calmer weather towards the end of July, which should bring the average production closer to normal as of the previous months. On the hydro side, the situation continued to improve with wet weather in the south of France, Italy, and Spain, along with decent snow melt. And this allowed for the hydro stock, which you can see on the bottom right chart, to globally remain in pretty good shape for the season. However, the outlook is less positive, with much drier conditions in the northern half of CWE, northern regions of France in worrying state, and a high risk of drought for the coming summer, although high-altitude snowmelt are limiting the risk for the nuclear power plants. Nonetheless, as a consequence of the higher temperatures, a downward trend of run-of-river production is expected in the coming weeks, and the risk regarding the modulation of the nuclear units should increase. So once again, and potentially as every summer, we should monitor carefully the weather evolution over the next weeks. However, it should be noted that the ISN already is the river temperature rule for the Blayais unit, nuclear unit in France, and RTE could push for the extension of the relaxation of the rule to other units in case of security of supply risk. And this is actually a good transition to the nuclear part of the presentation. So what about the French nuclear situation? What were the developments regarding the corrosion issue, and where are we at nowadays? Well, actually, there hasn't been tangible news on the nuclear front recently, but the market sentiment has noticeably improved over the past weeks. You may remember that a few months ago, the ISN finally approved EDF's maintenance and repair strategy, which was ambitious to say the least, with 90% of the most sensitive wells scheduled to be inspected by year-end, and the rest before Q2 2024. But nonetheless, the strategy seems to be paying right now, since the nuclear unit Nogent 2 outage duration was recently divided by 2, which is pretty good news and quite surprising. Although the ISN could take the opportunity to request more inspections, so let's see how it goes from there. And before we get to the Q&A part of the webinar on the power market, I already know what you are going to ask. What about the availability for this winter? Well, EDF seems pretty optimistic and sees its nuclear availability 5 to 10 gigawatts above last winter. But unfortunately, its declaration is excluding major outages, like for the corrosion issue, and the impact of the strikes from earlier this year. But anyway, as a result, the utility is maintaining its 300 and 330 terawatt-hour nuclear output target for this year, which we were kind of doubtful about a few weeks ago, to be honest, but right now it might seem reachable if nothing major occurs. As always, be very careful with the remit availability displayed by the red dotted line on the chart, as it is not aligned yet with EDF's target. Unfortunately, as you may have guessed, not everything is bright regarding the nuclear picture, since there was no conclusion nor comment on the thermal fatigue strikes following Panly 2 unexpected restart a few weeks ago. So uncertainties remain on that matter, and it's definitely not something to ignore, since the issue could potentially affect all design on the fleet. In my opinion, and we will see right after, this is also one of the factors explaining the massive risk premium of the French contracts over the rest of NWE. But before moving to prices, a quick word on the Belgian situation. ENGIE and the government finally signed an agreement defining terms for 10-year operational extensions of its Doel 4 and Tihan 3 nuclear reactors, involving contract for different support model and capped nuclear waste cost. However, a start in November 2025, which was the scheduled date of closure of the nuclear reactors, remains subject to a planned relaxation of nuclear safety regulations. Okay, moving to prices. So, as you can see, nothing much to say on the overall evolution of the day-ahead prices, besides that warm temperatures, weak wind, and rising gas prices supported the market in June. As you can see on the right chart, prices are back around 2021 level, but remains way above their pre-COVID level due to higher fuels and carbon prices. But what I really wanted to drag your attention on is the volatility of prices, which has significantly increased since June, and for once on the negative side of prices. But I think it's even more obvious when you look at the hourly prices instead of the daily ones as a left chart. So let's have a look at that. Okay, so up top, you have the hourly prices from the power spot market, and down below, a zoomed-in view of July 2nd, which really brings the situations to light. So as you can see, there has been a significant surge in the number of hours with negative prices this year, accompanied by a profound drop in prices during periods of robust renewable production and weak demand, mainly occurring on weekends and public holidays. So to put this in perspective and give you, let's say, an order of magnitude, the Netherlands has already witnessed 152 negative hours this year, while in the entire year of 2022, only 85 were recorded. So this is really an astounding increase. Moreover, the Dutch prices fell as low as minus 500 euros per megawatt-hour for several hours on July 2nd, or for July 2nd delivery, which triggered a second auction where prices even dropped a little bit further down. But now, what's causing such staggering drop in prices? Well, as I mentioned earlier, this is primarily the result of a massive addition of renewable capacity last year, combined with the lingering impact of demand destruction from the crisis, of course. And even though a recovery of the latter is expected at some point, even though not in the short term, as I explained earlier, the very ambitious targets recently set by the European Union with the Fit for 55 plan suggest that this situation could materialize more and more frequently as we move towards the end of the decade and potentially beyond. So basically, in the years to come, and until battery storage is implemented on a large scale, you can anticipate a growing number of hours with negative prices and price dipping as low as we have seen earlier this month and potentially even lower. While it will likely weigh on the power forward prices, since the average realized prices of spot one should be lower due to that, it may also increase uncertainty and the influence of weather on the market. So we might even witness a shift in weather-related risk premium in the future, which actually leads us to the forward market. So similarly to the previous segment, the overall situation hasn't witnessed significant change. But there are still some intriguing highlights to take note of. So as depicted in the upper chart, the power calendar prices have continued to follow the fuels and carbon complex, experiences a short-lived yet substantial short squeeze in June. My colleague Evariste already told you about it. And we'll delve further in the short squeeze in the first carbon slide, but it's essential at the moment to bear in mind that it's a standard technical move often observed in a strongly bearish market, and it's typically of a temporary nature. So we had already warned about it in our monthly reports, so it didn't really came as a surprise, and prices are already correcting as there haven't been any substantial changes in fundamentals. As I said, the short squeeze is usually temporary. As Avery mentioned earlier, gas stocks are currently at high levels, LNG imports remain robust, and the demand remains constrained. So all of that is contributing to the downward pressure on prices, even though the downward pressure has quite blatantly slowed. Now, when we examine each country in detail, some notable differences become apparent. Firstly, and you can see, I think on both charts, France is still exhibiting a significant risk premium for this winter, driven by nuclear uncertainties and the limited liquidity of the related contracts. However, it's interesting to observe that this premium has nearly vanished for the last quarter of 2023, and while it has begun to emerge for the winter 24-25. So we anticipate the premium for Q1 2024, which is really blowing the calendar 24 contracts and price. We expect this premium to correct by the end of the year, considering its current high level despite comfortable fundamentals on one side, and the market's reluctance to be short with lingering uncertainties on nuclear on the other. So once again, we are typically in the same situation as last year, where we have a really exaggerated premium considering the fundamentals we know at the moment, but unfortunately, we do not expect it to correct in the coming weeks or before last minute. Of course, it's not the same order of magnitude. You can see that 1 year ago, prices were much higher, but still, in terms of behavior, it's quite similar. However, the premium for the following winter seems more consistent, as it remains uncertain where gas stocks will be at the time and how the nuclear situation will evolve. Another interesting point is that the Dutch and Belgian contracts are trading slightly lower than the historical range, which can be attributed to the increased renewable capacity, particularly in the Netherlands. Of course, the low liquidity of the two markets are also at play for this. Now looking forward, There is still potential for further downward movement as long as the conditions remain favorable. By that, I mean as long as there is no unplanned maintenance on a Norwegian facility, LNG imports remain strong, which means limited competition from Asia, and French nuclear availability is improving while power demand remains constrained, we could see prices head further down. However, we see limited potential at the moment. Of course, I'm talking here about the German, Belgian, and Dutch prices, since, as I said before, the French contracts are displaying an exaggerated premium, and it's very difficult to say when the market will be reassured by the situation on nuclear and erode it. Nonetheless, so as I said, the remaining downside potential is quite limited, and there actually is an asymmetrical risk to the upside. So the market has been particularly nervous lately and tends to react quite violently to any news. We saw it in June, for instance, even if the actual impact on the balance is marginal. So any risk regarding nuclear, gas supplies, or LNG, for instance, would materialize, you can expect prices to rebound quite quickly. Similarly, the clear backwardation on the later dated contracts, so 25, 26, and beyond, despite the expectation of higher carbon prices in the coming years, along with let's be hopeful, a demand recovery and fewer additional LNG liquefaction facilities, suggests that the current level of prices are rather attractive and the risks are mainly on the upside. Of course, conversely, the rapidly growing renewable capacity across the region should offset some of the tensions in the upcoming years. All right, that's about it for the power markets. Of course, I will answer all the questions after carbon part, and you have the main drivers to monitor on the slide, but they have not changed since our last presentation, so I propose to move right away to the carbon part. Okay, so what happened in the UTS lately, and what's our insight for the future trends? Well, before we dive in, I propose to take a moment to address the two new charts displayed on this slide. So the blue curve represents the evolution of the EUA benchmark contract, currently the December 2023. And the two areas and black dotted line depicts the positions of the market participants. So on the left chart, the green area represents the gross long position of speculators, the red area represents the short position, and the black curve shows the net position, which is essentially the difference between long and short positions. So basically, when you see the black curve in negative territory, it means that the participants have a net short position and hence a bearish view. And conversely, when they have a positive black curve, it means that they have a long position, so they intend to buy allowances. They have a stock of allowances on the forward market. On the left chart, you can see the speculator's position, and on the right chart, the position of the emitters, so basically your industries, power plants, etc. All right, so looking at the evolution of prices in the past months, the blue curves, you can see that volatility materialized again as well in June in the carbon market with the famous short squeeze talked about earlier. But what is a short squeeze? Well, basically, it occurs when participants build a large short position because they have a strong bearish view of the market. Prices subsequently decrease, but suddenly a rebound materializes and is triggered by minor bullish news. The rising prices trigger stop losses along their way, or traders manually buy back the contract to limit their losses, which fuels the ascent and quickly push prices further up. As it's not fundamental, however, the move is often temporary and prices soon resume their downtrend. And this is exactly what happened in May and June in the UTS when a minor news from the gas market, I think I still talked to you about it, was enough to push speculators to cover their short position and push prices back toward 90 and above euros per ton. So as you can see, prices quickly corrected at the end of June. And again, it was a move we largely warned of in our frequent reports, so not much news there. However, what is really interesting for us is the behavior of compliance players over that period. So let's focus on the right chart. To give you a bit of context, the fundamentals of the carbon market have been constantly unsupportive over the past months with depressed industrial demand and continuous decline of gas prices. Nonetheless, you can see that when EUAs fell below their one-year average and even further below 80 euros per ton, and you can see with the black curve, the emitters suddenly increased their long hedging positions. So, of course, we have to mitigate the information from this because it could be a move from a big player without much fundamental reason. But in our opinion, it's more a sign that carbon prices below 80 euros per ton and around 80, 84 euros per ton are considered attractive for compliance players and therefore the level could constitute a floor in the coming weeks if the industrial situation does not worsen, of course. And this is one of the factors explaining our short-term outlook for carbon prices. So for this outlook, I'm afraid to say I'm a bit disappointed because I wanted to warn you about something and it actually materialized this week in the past 3 days. So we are in a very interesting situation where long-term fundamentals and supportive are facing short-term support. So basically, the market is still knowing a fundamental pressure with, as I said, a really depressed demand, a bleak outlook for the industrial sector, and still favored gas prices. However, you can see that prices stopped the downtrend, and up to today, we're hovering between the 1 year and 100-day moving averages, with support from a few factors. First, and I want to drag your attention on the bottom right chart, which is the coal to gas switch price curve. You can see in blue that the carbon prices are in the upper range for this summer of the range, which means that all of gas power plants are today more economically competitive than coal. And this also means that even if gas prices start to decline further, it will actually have a very limited bearish impact on prices because you cannot replace any more coal power plants with gas. A second factor was that seasonally, and then for this, I want to attract your attention on the bottom left chart. You can see that the auction volumes are divided by 2 in August to take into account the slower activity of the market. And while this is broadly anticipated by the market, it always tends to support prices because nobody wants to get short in a market where we have a risk of drought and power generators could have to buy last-minute allowances. So each year it tends to support prices, especially if we have a bullish risk materializing. And finally, but I already just talked about it, we have risk of heat waves and drought, which could limit the nuclear availability and hence increase the needs for thermal power plants and the subsequent demand for allowances. However, be careful, because in September, we could absolutely see a resumption of the downward trend of carbon allowances because we still have a depressed demand. We will have lower risk from the weather since the summer will have passed. And also, and this is perhaps something you may have not noticed, you can see in the bottom left chart with the red bar chart, which are the auction volumes monthly. And you can see that as of September, the MSR withdrawal will be lower because the surplus reduced last year, and hence the auction volumes will be higher than last year. Therefore, it should put an additional pressure on the market, and this is without counting, of course, the additional volume from the REPowerEU initiative. On top of that, we have 2 main bearish risks. One, if the French nuclear availability continue to improve without any new issue, of course, it will decrease the needs for thermal power plants. And if further decline of winter gas prices materialize, it will drive the EUA prices further up in the coal to gas switch range and hence put additional pressure on the market. On the long-term view, not much has changed actually. So we still expect a neutral to slow up trend in 2023. To be honest, we have slightly reduced our outlook for this year due to the very bleak outlook for the industrial sector. We also have, as I said, additional supply from the REPowerEU and additional overall auction supply. So basically, we shouldn't see a very strong uptrend by the end of the year. However, as you may have noticed, as of 2024, the Fit for 55 package will be implemented, which means that the overall cap of the market will be strongly reduced, and the cap will have a steeper reduction over the following years. So the EU ETS being an anticipative market, we could expect at the end of the year, when there is a possibility of cold spell, to see prices starting to rise accordingly. However, between 2024 and 2026, we still expect a lesser tension that we have experienced over the past years because the MSR withdrawal will be lower, and even we expect the MSR to be inactive as of September 2025. So that means we will have a higher auction volumes. We will have additional supply from the REPowerEU, and the third point is that the inclusion of maritime sector implies a progressive phasing of the sector, which means the cap will be adjusted with all the emissions of the sector, but only 40% the first year and 70% of the related allowances will have to be submitted by the sector. So this means we will have more supply than demand in the first 2 years, and of course this should slow the uptrend of allowances. Afterwards, it's quite the opposite, because the REPowerEU will have depleted the auction volumes. We expect the maritime and aviation sectors to be short and increase the tightness of the market. And of course, the surplus should be decreasing quite quickly. However, and similarly to the power market, the growing impact of renewable capacity, and we saw it particularly with the current spot prices, could pressure and limit the tension of the market by reducing the emissions needs from the power and heat generation sector. And to conclude, because the EUTS wouldn't be the UTS without a bit of regulation updates, now that the FIFA 55 and REPowerEU are fully negotiated, agreed on, and passed into law, the current policy discussions are actually focusing on the period beyond, so the fifth phase of the EUTS, between 2030 and 2024, and among other things, the target, the adjustment of the market. We are talking currently about 90% to 100% emission reductions target. It's still in discussion, but it's the main focus of the politicians at the moment. And that's about it for the power and carbon market. Perhaps we have time for some questions right now.
Yes. Thank you, Etienne, for your presentation. One question to start this Q&A session on power. I will just come back to one slide of the presentation. Can you just give us some clue about the difference between EDF official nuclear target production and the remit availability? We continue to see a significant difference between those two figures.
Yeah, absolutely. It's a question that comes quite often, and actually you can see on the bottom table that the current remit is displaying a 362 terawatt-hours production forecast, while EDF's target is only 300 and 330 terawatt-hours. And it's basically because the remit availability only includes the planned maintenance and the ongoing unplanned maintenance. It does not include any assumption on the coming unplanned maintenance, because by essence they cannot be forecast. While the target, in its target, EDF put assumption, probabilistic probably, on which reactor could go into unplanned maintenance, and that's why usually the target is lower than the remit availability forecast.
Okay, thank you. One other question regarding those negative price episodes. So, do you think we will continue to see regular negative spot prices episodes in the short term? And what is the current impact on the forward power curve?
Absolutely. So we can see a really growing number of hours in the chart. It's quite latent, and it should continue to be observed. Although in August, with the drought and higher temperatures, it should provide still some support to spot prices. So the level might be, let's say, a bit more contained. But in the coming months and years, it should be a quite frequent phenomena. And it already has an impact on the power forward prices, because if we move to the next slide, we can see on the curve then that the Dutch and Belgian prices, which saw the largest increase in renewable capacity last year, are trading below the German one, and of course below the French one, but it's another matter. And if you consider that the German one has the most liquid and biggest market of the European power, is, let's say, the more consistent with fundamentals, you can see that the two other are trading lower, which means really that the market is expecting, let's say, on average, lower spot prices in the coming years.
Okay, thank you, Etienne, for your answers. So it's time to go to the end of this session. So note that the next webinar session will take place in October 23. And before we close this session, I will just launch a small satisfaction survey. So thanks for your feedback This is always valuable to us. And in the meantime, you may have received an email from us at the beginning of the week regarding all the new features and content in EnergyScan. So be informed that we launch a new offer, the Elite offer, this month, giving you access to new data and also an API service to automate the extractions of all the data displayed in the EnergyScan platform. So don't hesitate to contact us if you want to launch a trial or to have a demonstration of all those new features and content. You have our email address and the link towards our website at the end of the presentation. So I will just give you 10 seconds to fill the survey before we close definitely this webinar session. Okay, thank you. I will close the survey. Thanks for those who took the time to answer. It's now time to close this session. So thanks again for your attention. I hope you enjoyed this quarterly session, and see you soon on EnergyScan. Goodbye.